Yo, what's up? Back at it with a pre-recorded video. I know it's been a while, but your boy had to get back in his groove. I'm Marcus, the debt-free dad. If you new to the channel over here, we're talking finances, financial takes, topics, attorney reactions, scammers, fraudsters, hoodwindlers, hoodwindlers, uh, finessers. What else you call it? But we just talk about a lot of stuff on this channel, but most times it's always tied, it's connected, it's looped back around to the money because everyone has to deal with finances. No matter how rich, how poor, how wealthy, how middle class, we all got to figure out this money thing and how to make it work for us. Even the folks with the silver spoon got to figure out how to make it work for them because they lose it because it happens all the time. We hear that all the time. In this video, we're going to start getting back into it. And I'm going to talk a little bit about treasury bonds, government bonds, T-bills, whatever it is you want to call it. Now, I remember at the beginning of the year, everybody was like, oh, the stock market suck. It's panicking. You should invest in government bonds. You can get them from treasury. You can deposit this amount. And, I always kind of gave it a little bit of the, I don't know. I always kind of gave it a little bit of the side eye. I never was a fan of bonds, of treasury bills. Actually, all of my portfolios, I literally don't have anything in bonds. All of mine is in the stock market. Now, I'm not saying that bonds aren't a good thing, but I'm telling y'all that it's not right for me. Maybe if I was like 62, I would probably put more of my money into government bonds. But right now, nah, I got too much time in the game. I can figure it out. I'm going to ride out with the stock market. But we're going to take a look at treasury bonds, look at some of the reasons why I don't use them. Y'all make your own decision. Y'all make sure y'all hit the subscribe button, hit the like button for the YouTube algorithm so this video can get out to more people. I always got to start with a disclaimer. I am a licensed attorney, but that does not equate to me being your attorney. So what that means is if you're looking for legal or financial advice, yo, you need to go over there, click on that video down there. Don't click on that video down there unless it's my video. But, hey, seek a professional in your local area. So, government bonds. What are government? Essentially, it's analogous to a certificate of deposit. A government bond is an investment vehicle that you can use it's 100% safe in theory. The reason it's 100% safe because you will never lose money. Government bonds have a fixed rate of return. That could be 3%, 5%, 7%. It depends on inflation. It depends on what the Federal Reserve set the interest rate at. But with a government bond, a treasury bond, you won't lose any money. You can buy them directly from the Department of Treasury's website. There's a fixed amount, a finite amount that you can buy in government bonds. So right now, the government bond rate. Okay, so here, and I'm gonna put it up on the screen, are the current rates. Okay, so right now on the screen, you can see what the rates for treasury notes are. You see some as low as 3.99%, some as high as 5.27%, some in between 4.43, 4.88%. Now, why am I, DFD, not a fan of Treasury bill? Because it requires you to lock your money up. And what do I mean by locking your money up? It's analogous to a certificate of deposit. You get this guaranteed fixed interest rate if you put your money into this investment vehicle for a certain duration of time and leave it there. It could be 6 months, it could be 12 months, it could be 10 years. They have varying times that you can leave this money into these vehicles. But as long as you leave it in there, you get these guaranteed rate of returns. And that's dope. That's good if you're a conservative. But, you really have to think about if a treasury bill, if a treasury note is in your best interest. Here is why I'm not a fan of the treasury bill. Right now, as the government continue to raise interest rates to fight inflation, you know what that means? It means high yield savings account interest rates are going up, 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 up. So, in theory, now if you got a bank like a Bank of America or somebody, you probably got like a 0.10%. But there are a lot of online institutions out there that have high yield savings account. Now, let's go ahead and take a look at the numbers for the high yield savings account. SoFi 4.40%, Lending Club 4.25, CFG Community Bank 5.17, Popular Direct Bank 5.05%. I mean, it's just so many banks. Look at this. Wells Fargo 0.15%, Chase 0.01%, Bank of America 0.01%. Okay, so a lot of these institutions have high yield savings account rates that are equal to or just on par with a treasury bill return. So for me, I don't see the benefit of locking my money away in a treasury bill or a certificate of deposit for that matter, to not have access to it, to potentially have some penalty when I could put it into a high yield savings account and get the same return. So, like my emergency fund, I'm not putting it in a certificate of deposit for 12 months where I can't touch it unless I get penalized, or a treasury bill. I put it in a high yield savings account. I let it get that full 5% interest. I'm right on par with the treasury bill return. And if I need it because it's an emergency, I'm going to go ahead and take it out and I don't have to worry about a penalty. Now, understanding that if the economic climate changed, the rates on the high yield savings account can go down, the rates on the treasury bonds could go down. For me, emergency fund money is about emergency fund and it being accessible, not locking it up. So I really don't give a damn what the interest rate is. Anything outside of that, if I were older, if I were more in my working years closer to retirement, I probably would restructure my portfolio to include some bonds in there to kind of preserve some capital. But right now, your boy got a lot of time to work. And I'm gonna just be honest, it's just not worth it. It just mathematically doesn't make sense. A lot of y'all think that this is a terrible time for the stock market, but this is a booming time for the stock market. It's only terrible for the stock market if you don't know what you're doing. And I'm gonna talk a little bit about this later, but I wanted to take a look at my rated return this year for one of my portfolios. Let me go ahead and pull it up while I got y'all here right now. 16%, but your boy got to make sure. And I want to pull up the right numbers. Then I'm going to screenshot the number and put it up on the screen because I don't want y'all to think I'm in here capping. And I'm going to actually break down this investment that I'm gonna show y'all later on in the week. All right, so we loading it. We about to jump in right now. I know I could have edited this out, but I like the suspense so we can get it. And it's gonna take forever. All right, here it goes. Loading up. All right, my return this year so far is 16.61%. I'm gonna go ahead and screenshot because I'm gonna need that number. I'm gonna throw it up on the screen. But right now, my rate of return on one of my primary investment portfolios is 16.61%. So it would have been foolish of me to take that money out to put it in a treasury bill to get 4 or 5%. It just wouldn't make any sense. So that's kind of why I'm not really a fan of the treasury bill. I'm not telling you not to do treasury bills. If you want to get a government bond and secure a rate of 4% for the next 18, 24, 10 years, Godspeed, have at it. But for me, it doesn't work in my plan. And I'm not really an aggressive investor. That 16.6% that I got from investing in funds that track the S&P 500. That's all I do. It's not fancy. I'm not buying Tesla stock. I'm not day trading because a lot of those guys who are doing all that day trading and stuff, if they got 16% this year, kudos to them. But it's just my approach is steady, consistent, and gradual. Y'all let me know in the comments. Are y'all a fan of treasury bills, certificate of deposit, locking y'all money up for that long? Right here is not for your boy. That rate of return is too much for me to miss out on. Even if the market was down, I'd just much rather ride it out. The market average in the long run will do me more benefit than any return I would get in a 1 or 2 year period on a treasury bond or a certificate of deposit. That's it for this video. If you enjoyed this video, check out the video on the next screen. I'm fumbling my words, but it'll be more content related to finances